Good morning and welcome to the Pureprofile third quarter 25 results investor briefing. My name is George Copsey-Aftis and I'll be your moderator for today. With us today this morning, we have Pureprofile CEO Martin Phillips. Good morning, Martin.
Morning, George. Morning, everybody.
And the CFO, Melinda Shepherd. Good morning, Melinda.
Morning, George. Morning, everyone.
So the format for today is for Martin and Melinda to walk you through the presentation that was released to the AEST this morning. This presentation should take about 20 to 25 minutes, and then will be followed by a question and answer session. If you'd like to ask a question, please click on the Q&A tab in the ribbon below and type your question into the box provided, and I'll ask it on your behalf. Just as a reminder, this briefing is being recorded, and we'll put a copy on our website once it's available. That completes the housekeeping for today, and I'd now like to hand it over to Martin and Melinda. Get us started.
Thank you very much, George. And as I said, good morning, everybody. So we're delighted to go through the Q3 update, and Mel will, as usual, talk about the financials. Difference this quarter, we've got some exciting news about some new products that I will talk to as well. And we'll start off just giving a bit of background to Pureprofile for any new investors who are joining the call today. So Pureprofile, we're a data and insights company. So what does that do? Well, look, every product you buy, the car you drive, the clothes you wear, the ads you see online, the policies that you hear from either side of the government, they have gone through some form of market research to ensure that they are relevant to the audience that they want to reach. And that's what a data and insights company does. It helps connect the question that the business has, or government or university, whatever it has, with the consumer, with the data, and that's the connectivity. And that's what Pureprofile does. So we connect organizations with we've got millions of people around the world, and we connect them broadly through online surveys to answer questions and to get a gauge of does that resonate with that work, etc. So that's what we do. And the idea is so that the business can make better, more informed decisions than it currently make, or make without that. So that's what we do as a business. Where do we do that? Well, we've carried out research in the last 12 months in over 89 countries. So we're truly global research company. Physically, we have offices in 14 countries now around the world. We have so close to 900 clients. We have 899 clients globally, 247 staff. We have about this quarter, and as I said, Mel will go into detail, 12.7 million of revenue, which is another record quarter for us, quarter three for us, which is fantastic news. And we have about 13 million continually growing in annuity revenue, which allows us to be much more predictable, forward-thinking business. So we're truly a global business, a global entity now. The company, what does that mean? That means clients can turn to us and actually can run a single project in multiple countries, and they can do that with confidence with Pureprofile. Now, I joined the company nearly 5 years ago now, August 2020. Mel was 2018, so she's coming up 7 years in the company. And 5 years ago, we put in a clear strategy for the business. So number one, it was to lean into being a true global company. At the time, we had offices in 5 countries, weren't truly connected and truly global. And it's about leaning into and exporting what we do really well in Australia into those global markets. They're much bigger markets than Australia. And you've seen rest of the world grow much faster. And again, Mel will talk to that. The second area was we had very little of our business was technology led, and none of it was AI. We weren't even talking about AI 5 years ago. That's some 2 years ago, but very little of it was technology led. So we were very much a managed service. So the second focus was actually to be a technology led business. And the first was internal systems and getting all those right, and then looking at external systems and connectivity to clients and automated. And one of the byproducts of that clearly is that expansion that we've seen in the EBITDA margin and that growth in revenue, because it gives us access to a wider range of clients. So global, bigger markets, technology, more clients, more efficient ways of working. And then again, 5 years ago, Pureprofile was a little bit of a confused company. We had some media businesses, we had some data and insights businesses. So it's been laser focused on being a data and insights company. And that gives a true identity for clients, for all of our team members around the world, for the market. And they recognize now Pureprofile as a true leader, global leader in this space. So we've had that clear strategy in place for over 5 years, and that still remains absolutely true. Why is the rest of the world so important? Why do we see that growth? And it's typically double the growth that we see in ANZ, established market ANZ. The US is about 40 times bigger than the Australian market, and the UK market is about 11 times bigger than the Australian market. So huge opportunity. It's doing exactly the same thing in exactly the same language, but just doing it to a bigger market. Clients, individual clients spending more money and more clients spending money. And we've been in the UK for about 10 years now, and we've seen that. We've now got 20 people sitting in the UK and seen that growth in the UK. And for the US, we've been cautious about the US. We still do that remotely. We have a US dedicated sales team in our UK office, and we do that remotely still, and being cautious about investment, and it can be very expensive. And there are lots of companies that have tried the US and haven't succeeded, but that's those two markets, absolute focus, and that's where we're seeing that growth come from. Audience intelligence, as one of our directs says, there's a lot of greenwashing that goes on about audience intelligence. Lots of businesses talking about it. Where are we seeing the rubber hitting the road? Well, internally, we've rolled out a number of new solutions. We now do all of our 89 countries. Remember, we did research in the last 12 months. All of those projects need to be translated from English bit into French, German, Indonesian, whatever it may well be. We now do all of those translations using AI. We used to use third parties. It cost us a few $100,000 a year, and it would more importantly, would take 4 to 5 days for those translations to get back to the client. Now it's instant, so we're cheaper, faster, better quality. So we do all of that, added to the bottom line, delighting our clients even more. A bit of technical, we do something we call coding, probing, and reconciliation, all now using AI. It's just making us much faster, much more efficient, and it means we're able to grow as a company without having to add resources. 50% of our resources broadly live in India and the Philippines, where they're doing follow the sun 24/7 and manual work as well as support. And it means that we've been able to grow our revenue without having to grow that salary base. So we've seen that advantage, and you've seen that come through in the EBITDA margins. Client-facing solutions, we've rolled out a few in the last 12 months. We've got something called the Hub, where all clients now come through. That's a great branding opportunity, centralizes, and they can also see cross-sell opportunities, other products that we have available. Audio and video, moving into qualitative research. Mainly we do quantitative research. What does that mean? Brand new clients. It's actually at a higher cost per interview, so it makes more money. Smaller market, but it's a brand new market for us. So that's automated surveys, videos, audio, and then some other new products. We'll talk about those. And then the last one is AI clients. And so it opens up the AI world. When you type a question into ChatGPT, it's got to get its data from somewhere. And the best form of data is first party, real people who are actually sharing opinions, sharing data, behavioral data, etc. So it puts us in a great position to feed information data to those AI clients. So we've got global, big opportunities, bigger markets that we're leaning into, and we've also got those efficiencies coming from AI and now new product, new revenue streams. Bit of history for those of you who don't know. Well, we floated in 2016, made a couple of acquisitions. That didn't work out very well. I ended up with a load of debt. And in 2020, I joined. Mel was actually brought into the company to right the ship. I came in 2020, and we undertook a restructure. So we did debt to equity swap. We got rid of all of our our debt. I brought in new executive team. We closed down a lot of the media businesses and really put ourselves in a firm footing. 22 to 24, a few things happened. I mean, firstly, when you look back to financial 21, the reporting that you see and that Mel will go through is completely consistent. So we haven't changed a single metric of how we calculate, obviously how we calculate revenue, EBITDA, and now NPAT. So we've seen that steady growth and continual growth of the business. And the focus for us has been, number one, for Mel and I, number one, we don't want to raise money to keep the lights on, so be cash flow positive, operate cash flow positive as soon as possible. And within a couple of quarters, we were operating cash flow positive. Next focus was to be truly NPAT positive. Half year, we hit NPAT positivity for the first time in the company's history. So really excited about that. And meantime, behind the scenes, not only have you seen that growth going on of revenue, etc., we've actually been re-engineering the whole business. So as you can imagine, if the company wasn't doing well, there hadn't been a lot of investment in technology. We were re-engineering our technology. We were making sure we were a truly global company. So if I'm a team member sitting in London or Amsterdam or Singapore or Sydney, I have exactly the same experience to my colleagues. And that goes for clients as well. I can access global systems. I have now an open environment that I can connect directly to, and I can interact with Pureprofile without needing to touch people. So all of that was going on behind the scenes. We used the phrase of it was like changing the wheels as the car was still moving down the road. And that's what we were doing at Pureprofile. And as we've come through that, now we're in 25, looking forward to 26. It's about leveraging off of all of that work, that structural work that we did in 22 and 24. And during that period, by the way, we still continue to far outperform the market and our competitors in gaining that market share. But we were doing all that work, and now it's about leveraging off of that. And now it's about accelerating and kicking on with new solutions, new enhancements, and new ways of working with clients. And I'm delighted to be able to talk to some of that. Key priorities for 24. Well, let's hit guidance. That's key priority. Driving growth, so cross-selling to clients. We've got, as I said, 899 clients. So how can we expand that share of wallet? How can we increase the number of clients that we work with and the market share that we have in businesses? The number of products and solutions generate. It's all platform products, by the way, so it generates higher EBITDA margin and also a different type of client that we don't necessarily work with today. Targeted investment particularly in the UK for Q4 to accelerate that UK growth. And then we continue to explore partnerships in the UK and US. For those of you who know, we have great partnerships around the world. For example, Flybuys in Australia, where we have access to their audiences to deliver, or members to deliver surveys that feeds our clients, that feeds our revenue, that feeds our business. So we continue to explore and expand those in the UK and the US. So drive growth for Q4. The second one is improve margins. So how can we move from managed service business to more of a platform business, platform making up 26% or so of our business today. It was almost zero 5 or so years ago. So growing that platform revenue as we make that shift. Automated client solutions, helping that client revenue and that automation to work. AI, utilizing that. And it's not just AI, and you've all heard this joke, as our CTO says, please stop talking about AI. We talk about opportunities or problems that we solve with technology, and sometimes AI is relevant, but it's a good way of being able to have some quick wins across the business. So we continue to improve internally, operationally, in both ways of working and through technology. And then on the right-hand side, global business, winning those new clients, building those commercial partnerships, technology and AI, as I said, internal and new products being about self-service, growing that platform revenue now through the business, and then focusing absolutely on a data and insights business and growing our data points so that we can answer more questions for more clients. We've talked about our aspirations throughout the year, and this has been true. 26 to 27. It's about doubling our UK revenue, tripling our US revenue. So absolute focus. Triple our platform business revenue. More client-facing solutions. So having an absolute focus on external innovation, not just internal innovation, and to really be a significant player of data and data training data in that AI space. It's a brand new market for us. We don't work with clients at the moment in that space, and there are a number of competitors who do work in the AI training space, and we know there's one particularly in Australia, and it's about now entering into that space as well and taking some of that market share, as we've done so well in the data and insight space. And then the third point is merger and acquisitions. We made a great little bolt-on acquisition with iLink it completed in July of this year. That added people, it added clients, it added revenue, it added data points to us, and it added bottom line profitability. So that was a great bolt-on. We've got a lovely blueprint now for acquisitions like that. So can we see any others, particularly UK and US, that give us a bit of a step change? Don't want to bet the farm on it. Don't want to see dilution to the business, but what can give us a step change towards our aspirations that we have? So that's a continual thing that we do look at, whereas, as I said, organically growing fantastically as a business. And then how do we improve margins? Well, we're seeing that reducing costs versus revenue, that economy of scale come as the revenue line increases, but we have a fixed base now as a business. Focus on seeing a better return on that salary contractor cost to our revenue base, which again comes from improvement of systems, improvement of ways of working, and client-facing solutions that give DIY access, do-it-yourself access. Reduce reliance on suppliers. I've talked about this many times before. We buy the missing data points from the network, from our frenemies, from competitors. How can we reduce the dollar spend on that? How can we buy that more efficiently? And how can we increase our own platform, our own panels, like buying a company like iLink, for example, like having an audience builder partner like Flybuys that helps reduce all of that. And then finally, it's really being seen as a technology-led organization, both internally as a business and externally to clients. And that is now starting to accelerate through. Now, I know normally I would stop now and say it's over to Mel, you've heard enough from me, but I'm going to talk a little bit about new solutions that we're really excited about. So bear with me a little bit longer and then we get to the number. So in Q3, we launched a couple of solutions. So the first one we launched is what's called synthetic responses. And I don't want to get too technical on this, but basically you might find it really hard to get hold of the final few 10%, 5% of a project for a client for whatever reason. And so we may go out to a market to purchase that 5%, 10%. Or we might really work hard in our internal systems to get it ourselves. And so what does that mean? You've got a slight higher cost for that final 5 to 10% finishing. You've got a time that it will take for that 5 to 10%. Well, through AI has long come something called synthetic responses. So we partnered with a UK company called LivePanel. And what it does is we're able to find those missing responses, those missing data points through extrapolating the existing people you have. So AI looks at everybody you've already got responses on. It looks at the survey that you're running, and it actually it really quickly computes what might that 5 to 10% look like in all of the different areas that you're looking at the business. It works phenomenally well, 93% accuracy. Which clients are very happy with. Why does it matter? Because it's a high quality still, it's contextual still, but it's way faster. So the final 10% of a project might take 30, 40% of the time of a complete delivery you're now delivering that in real time back to the client. So we're faster, maintaining quality, and we're more efficient for ourselves. So that increases our margin. So excited with that product. Second product we launched in Q3 was in partnership with a US-based company called Quilt.ai. And this is a purely AI company. They every day they're scraping hundreds of millions of users around the world who are using Reddit or Facebook or Instagram or LinkedIn, and they're making comments, they're making points, TikTok, they're uploading videos, whatever it is, and they're sucking in all of that data. And that's, for example, how something like ChatGPT-4 works. When you type in your question to ChatGPT-4, it pops up some answers. Well, how does it get that? It's been scraped, that OpenAI has been scraping that data from Google or Facebook or wherever it is to be able to give you that answer. Well, Quilt.ai does that as well. But the difference with Quilt.ai is it then delivers the data in a way that it's really familiar and usable to our data and insight space. So it's relevant to our data and insight space. So it's really a powerful tool. So we have 3 solutions that we've launched with Quilt.ai. Social media, take that as a ChatGPT-4 type solution. Clients can type in their question, whatever it is, and they get the answer back. Electric vehicle owners in Australia. What are the what's going to happen in the future? What are people interested in? What are people talking about, etc.? And it helps maybe formulate a client discussion or a piece of research they're going to run, etc. The second one is consumer trends, really powerful product where it again distills down what are people doing today. What are people accessing today? So I can start to think about slightly the future. And again, it is literally on anything. So if it is on soft drinks or toothpaste or medical or cars or whatever, it actually enables clients to go in and again, instantly to be able to go through a SaaS platform product and to look at things for the future. And a deep dive on that one product vertical that we've also launched is beauty trends, where again we scrape everything that's going on, people are talking about, whether it's the latest mascara or blusher or foundation. I talk like I know about these things, but whatever it is, and then whether I'm Maya thinking about what am I going to stock in the future, or I'm Sephora thinking about what am I going to ask my manufacturers to develop in the future. It's a really powerful tool that enables them to think about, okay, what am I going to be doing for the next season? What's my target audience talking about? So really excited with those 2 solutions. In Q4, we've got something called conversational AI coming out. So what this does is it's a faster, quicker, easier, more user-friendly way that an individual might respond to one of our panelists responds to a question from our clients. So it allows a better experience a better engagement and experience for our panelists. It enables better quality, higher quality responses for our clients, because people are being asked natural flowing questions. I see on the last question, you said you like McDonald's because you go to McDonald's because of the price. Can you talk about that a little bit further? What are you comparing that to? And then it's a natural way we all talk rather than perhaps a stilted way sometimes surveys are. It says, oh yeah, it's better price than Domino's is, or it's better price than Hungry Jack's. So it's a natural language way that clients, respondents reply to surveys, and it elicits better information for our clients. So faster, actionable, more deeper data. So excited about that product. And then the final 2, I'm particularly excited about. So you're not meant to have a favorite child, are you? So we've got 2 big products coming out in a couple of weeks' time. And they're both around self-serve data and insight solutions. And it has a branding that we're not going to talk about yet. So firstly, I have a full global DIY solution. We've had for a good few years Insights Builder. We have some clients that use Insights Builder, Budget Director, Door Beauty, and others. And it predominantly only runs in Australia because it only links into our Australian sample and our Australian client base. This release is a true global release. So it links into global data points and also multi-language, multi-delivery for clients. So I now have a global self-serve product. So I can create a survey, I can manage my sample and field work, buy my sample and field work through it as well, monitor, great reporting, lots of AI added within this as well. And then I've got fantastic reports to send. And the difference for our product compared to, you might know, SurveyMonkey or Qualtrics, it's our sample. We have direct sample that sits behind it. Many of those other global solutions do not have their own sample. They have to come to Pureprofile for sample behind it. So it enables us to go after competitors with sample more efficiently, higher quality, potentially better price. It opens up a whole new range of clients that we haven't worked with before who want to work in the DIY space versus the managed service space. And guess what? It adds to our platform revenue. So we're going to be more efficient. We're going to see those EBITDA margins go up doing it. So I'm really excited about that solution. And then we're also launching, second solution is what we call a sample only tool. So take off I built a survey using our new global scripting platform. That's gone. But now what I've done is I've built it in SurveyMonkey, I've built it in Qualtrics, and now I can go through exactly the same process to access the Pureprofile sample. So previously I would have had to have manually or been managed service. I've gone to salesperson. I've got then that salesperson would won the project, it's gone to India or the Philippines. They've done something, we've delivered results. Now the client is able to do all of that without touching anybody at Pureprofile. And the first thing they get is an invoice that comes back. So the really exciting thing about that is it's our own sample. Again, though, I'm increasing my EBITDA margins because I'm not using people to deliver. I'm faster, I'm cheaper, and I'm still maintained that high quality. So I'm really excited about those two products as well. Now, why? It's cross-selling our existing clients, being more efficient the way that we work with our existing clients. It's bringing in a whole new raft of new clients that we don't work with today, but it's completely parallel and aligned with what we do as a company. We're not changing our strategy. It's just delivering those answers in a more efficient, faster, and as it says here, high quality insights delivered at scale. So really, really excited about that. And it strengthens our mix as a company and really positions us now as a technology-led data company as Pureprofile. Now, I'm going to go ask about revenues and what's that going to do to bottom line. We'll talk more about that in the full year, but we'll see this. We'll do a soft launch in May, start to talk to clients. We'll see little impact at first half 26, and it'll start to come through 26, 27. But still, we're moving from 80% or so of, or just under, of managed service, and today 20 or so % of a platform. So it's not going to change our business overnight, but certainly it's going to enhance, add to our business, and talk to the Pureprofile of the future. So there we go. I am now going to have a break. You're all going to have a break from me, which is lovely, and I'm going to hand over to Mel.
Thank you, Martin. It's very exciting, all these new solutions. The team are working incredibly hard to get them ready for launch. So I look forward to the launch in the next month of some of the new solutions. So we have had another fantastic quarter. I know that we say this every quarter. It was another record quarter for Q3. We came off the back of a really strong half one, as you all know, when we put our half year results out. So we delivered 16% revenue growth on the prior quarter to $12.7 million. And what's really interesting is that's comparing to the same quarter last year where we only did 6% year-on-year revenue growth. So that's an amazing outcome for us. I mean, it's really the fact is that we've built off that first half momentum. continue to focus on being competitive in the market, particularly in Australia, where it has been incredibly competitive this year. Last year, you might recall, it was a little bit more challenged, the ANZ business, over a period of about 4 months. And now we've adapted that business, the strategy around how we go to market, and we're really seeing that sort of uplift in revenue. So the ANZ business did 10% revenue growth, and that obviously included the uptick that we would have picked up from the ILIC acquisition, which is fabulous. We're really, pleased that we did that acquisition. It's really helped to bolster this region. In the same quarter last year, we actually only did 1% revenue growth. So that sort of shows how we've adapted the business in that competitive environment. And then if we look at the rest of the world, we did 24% revenue growth compared to 11% in the same quarter last year. The other thing that I just wanted to point out between, and we know our strategy is really growing outside of Australia. We've put our investment there for the last couple of years, and we've seen that, much stronger revenue growth in the 20s up to the 40% for the rest of the world. But what's really interesting about the Q3 result is just that difference between the ANZ revenue and the rest of world, where there's only about a $500,000 gap there, but in the same quarter last year, it was about 1.1 million. So it really does demonstrate that the strategy that we're executing well, and you're starting to see the benefit of that. Obviously, we've been seeing the benefit of that over the last couple of years, which is fantastic. EBITDA was up 16% on the same period last year. If I go back to last year, and I'll talk a little bit about that when we get to the next slide, actually our EBITDA growth declined for Q3 last financial year by 49%. And I'll talk about those reasons when I get to the next slide. But one of the things that I really want to be really clear about is, Martin and I have always had a very disciplined investment strategy with the business. We've been conservative. And I don't think there's ever been a stronger time for us to continue on with that strategy. Nothing's really changing. We are keeping an eye on what we're hearing from our clients. Obviously, there's a lot of global uncertainty at the moment. And so what's really important is that we continue to focus on our cost base, making sure that it's right size for the revenue growth, not investing too far ahead of the curve, particularly in this uncertain environment. And so it is really important for us to make sure that we are aligning that investment with the revenue growth that we believe that we'll continue to experience over the next the next 12 months in particular, whilst we still are in that uncertain environment. So no real change, but just keeping a closer eye on it. EBITDA margin was in line with last year too. EBITDA margin's always lower for Q3. It's a seasonally low quarter, predominantly still because we've got that strong ANZ revenue and the seasonality of January and February. So it does always impact us, and we have our cost base set up for typically our stronger quarter in Q4 that we will go into. So the next thing I want to talk about, I haven't got a slide in here, but just is really where we're tracking from a year-to-date perspective. So we're tracking at nearly $42 million worth of revenue. If you recall what we did last financial year, we did 48 million for the full year. So we're tracking really well with good, strong growth year on year. And EBITDA is tracking at 3.9 million compared to 4.4 million for the full year. So we're tracking well this year. Our year-on-year growth is still strong for revenue and from an EBITDA perspective. And the ANZ business is tracking 14% up on the prior period for the full year, and the rest of the world at 27%. Just pointing out the platform revenue here, 2.2 million or 11%. Last quarter, last financial year, we actually had 99% growth. So we're really cycling off a very strong growth in the platform revenue last year. So whilst you look at that number and you might go, what's going on? It's actually just a reflection of what we saw last financial year in a seasonally low quarter as well. And as Martin said, what's going to bolster that revenue, not so much in this year and the first half of FY26, is actually some of the new solutions, which are tech-enabled revenue. And we should see a further uptick of those solutions and the revenue generated from it in FY27. If you go to the next slide, Martin. Again, I think this really starkly contrasts the growth that you've seen in the rest of the world and how quickly it's been catching up to the ANZ business. And then I just wanted to point out, as I said, the EBITDA, there's a bit of an anomaly that you sort of look in those charts, that something that you don't normally see in our trend charts is obviously the EBITDA for FY23 Q3 was 1 million, and then we dropped down to Q3 FY24 down to 500,000. So there's a couple of reasons for that. Last financial year in Q3, our expenses growth outpaced the revenue for that quarter. We were challenged in the ANZ business. And as I said, we've really adapted our go-to-market strategy and ensured that we're operating strongly in that competitive environment. So that's really helped to ensure that in this quarter that our cost base is right-sized for the revenue growth. So we had much stronger revenue growth compared to the expense growth in 23. And then the other anomaly between those 2 years was in FY23, the short-term incentive was an equity-based incentive. And in FY24, it was a cash-based incentive, so it impacted operating expenses. So that's really why you saw that anomaly in that year. And then you've sort of gone back to it sort of more of a normalized growth from that perspective. And a key part of the rationale behind us ensuring that we've got that right-sized cost base compared to the revenue growth that we're expecting. And you'll continue to see that when we go into the next financial year, which is not that far away now. If you go to the next slide, please. So we are reaffirming our financial guidance. You might recall in January when we put out our Q2 and preliminary half-year flash results, we reaffirmed our financial guidance for the range, and we tightened the range, obviously, from 57 million to 58 million, and EBITDA of 5.2 to 5.8. We are still very comfortable with this range, particularly obviously after finalising our Q3 results and what we can see ahead for Q4 at this point in time. And just a little cash update. I don't disclose our cash balance within the quarters. We've had a good cash generation in Q3. We did make a payment, the final cash payment for the iLink acquisition on the 1st of April, so that will impact the cash balance. But I would expect that cash balance at June 30 will be higher than what you saw at the half year. So I'm just going to say that from that point. From a cash collections perspective, we've been heavily focused on cash collections and ensuring that we minimise any bad debts that could be incurred in this period. Obviously, global uncertainty does impact businesses' ability to pay. We've reallocated a lot of resources within finance to ensure that we're really well on top of collections. We've had an incredibly strong cash collections quarter for Q3, and that we've seen absolutely no uptick in bad debt in our business. You might recall we took up a bad debt provision for one client in the first half. We're seeing no evidence in our business of any uptick in bad debts. And I know that you probably, if you're invested in a number of other companies, may have seen that that sort of trend at the moment where collections are slowing down. We are making sure that we're on top of that. Obviously, that sort of flows into our disciplined, conservative approach of how we manage the business, particularly from a cash perspective. So that's really it from me. As I said, really happy with our Q3 results, and we're tracking really well towards this guidance. So I'll head back to Martin for just to wrap up.
Thank you very much indeed, Mel. So yes, I mean, it is the Rapid summary. Record Q3 for us, 16% growth driven by that continued revenue momentum. Obviously, we made the iLink acquisition as well, close to that at the beginning of July, and seeing that double-digit or double the growth from the rest of the world. Great to see that ANZ revenue growth at 10%, where it is a mature, very established market for us. 24% rest of the world, as I said. Reaffirmed 25%, reaffirmed financial year 25 guidance, which is fantastic. And we've got some cool products and tools for existing and new clients. So thank you all for listening. And now I'm handing over to George.
Great. Thank you, Martin. Thank you, Mel, for that great update. Again, if you'd like to ask a question, just click on the Q&A ribbon below and type your question in the box, and I'll ask it on your behalf. There were a few questions that came in by email earlier, so I might just start with those while we're waiting for the Q&A box to populate. Martin, the first question, I think you spoke to it a bit, but just to reiterate, the question is, are the new solutions that you launched intended to attract new clients/revenue with new solutions, or retain clients looking for cheaper solutions?
Yeah, good question, George. So, thank you for being asked. So, what's the DIY, both of the DIY solutions opens up to new types of clients, especially the self-service scripting tool or survey writing tool. That opens up particularly to brands. So working more to direct end brands than we do at the moment, where we spend a lot of time working with research agencies. Fantastic, but it opens up a new field to us where they can script their surveys. So that's new brands within that space. It's a new raft of clients because we haven't had global DIY tools before, either the survey writing tool or the sample only tool. There's a whole swathe of the market that does DIY delivery, the clients that want to work in that way. And so suddenly we're able to access those clients. So that's particularly exciting. And then our existing client base. So again, existing clients who perhaps want to work in a different way, want to try some new tools and also see us as an innovator. So new clients, new revenue, and new ways of working. So yes, we're all ticking all of that.
Great, thanks, Martin. Next question. I see the social insights tool is a partnership with Quilt.ai. What about the other new tools? Are they proprietary to Pureprofile or are they partnerships? And if they are partnerships, how does the revenue share model work?
Yeah, again, a great question. So we're now an attractive distribution channel to partners. 14 offices, 900 clients. Especially if I'm a US-based company that's built some tech, who doesn't want to open up an office in Australia or London or wherever, and I'm happy just working in the US market, we're now attractive to them for a distribution network. And we have, if it's obviously adjacent to our clients, this is of interest to our clients as well. They increase the share of wallet and increase the client share, and brings in new clients. So that is leveraging Pureprofile as a distribution channel, which is the first time we've started to do that. Now, that gives us another added benefit. I've got a tried and tested solution that I'm bringing to market that already has a rich client base, that already has marketing, etc. My cost of launch is phenomenally lower from a finished product standpoint. And then the other advantage is I haven't had to build it. So the fact that I haven't built the product, I'm able to come to market much faster at a lower cost. And then I can make sure we haven't got any of the partners listening. I can try it out. So I can see where's the rich vein of gold, what actually is really resonating with clients present or future. And then perhaps we'll bring some of that development work in-house at a stage in the future, perhaps not. So it enables me to be faster to market, lower cost to market, more efficient to market, but I'm delivering something new and exciting for my clients. When we talk about revenue share, it really depends. It depends. They're all platform-based, firstly. They're all typically subscription-based, so that increases that efficiency line. But it depends on the product. It depends on the price point that is the share of revenue. What's important is what it actually ultimately delivers, where my interest is in more data delivering sample requests from clients. And I don't do any revenue share on that delivery. So I might go to a client and it could be one of the fantastic Quilt solutions who are an amazing partner. I'm delighted to be able to work with them. Actually, what does that mean? Well, it might be a brand new client that I've never worked with before who doesn't use my data. I've got a revenue share on the product that's come through, but now they know about Pureprofile. What else do you do? Oh, yeah, we can do your ad hoc research. We can do survey responses. And we've got these DIY tools to deliver that. And now my real interest is how does Pureprofile deliver more data to those clients from our existing pool? So that's the absolute upside, and I don't do a revenue share on that.
Great, thanks, Mark. Mel, one for you. Is the FX for second half tracking favourably for the group financials and guidance? And in brackets, it says first half FX was favourable. So I'm assuming it said that you had favourable FX in the first half, but how's the second half looking?
Yeah, that's a great question, actually, because I know that I did point it out in the half year results that we had a 462,000 positive foreign exchange gain, predominantly due to the weaker Australian dollar against the pound and the US dollar and the euro, etc. Q3, the foreign exchange gain was 6K, so it wasn't really worth pulling out. And in the same quarter last financial year, we actually had a $100,000 FX gain. So it actually probably negatively impacted compared to the year before the FX. So we haven't seen, a shift to a FX loss. I suppose we just have to wait and see what happens in Q4. We have converted a bit of our US dollars when the exchange rate was really strong into Aussie dollars. And I think that will help minimize any real impact if the Australian dollar gets stronger against the US dollar in the coming period of time. With that sort of volatility in exchange rates, we were actively monitoring the exchange rate, and then when we saw a favourable time, we were converting a bit of it to Aussie dollars, but obviously making sure that for any expenses that we have to pay in other currencies that, we're not having to convert back from Aussie to US dollars if we have to pay them. So a little bit of treasury management going on there, but, it is, I'm happy to take the FX gain when I can, but I don't want the downside at the same time as well. Not something I can absolutely control, but making a little bit of a gain where we can is not a bad thing.
Thank you. One for you, probably, Martin, around M&A. It says with the shares trading lower over the last few months, is M&A still a short-term or longer-term option?
Yeah, good question, Ron. Look, it really just changes the field of M&A that you can do. If I'm 200 million market cap company, then I'm still buying within my multiples, and I can look at different acquisitions too if I've got a $44 million market cap. So it doesn't necessarily change the aspirations. We're still cautious. We still know we can absolutely grow organically. It just changes the sphere of companies size companies I can look at.
Okay, thank you. And I've got a couple of questions here, and they're all similar, so I'll try and blend them into one. I guess with Donald Trump coming into becoming president and also the Australian elections at the moment, are you seeing any impacts into the fourth quarter? And just to add to that, it says is client spend or decisions being delayed at all?
Yeah, look, I mean, obviously it's something that would be concerning for most businesses. I mean, I think there's a concern that, you end up in a global recession, and that's obviously going to impact client spend. We're not seeing any direct impact on our client spend at the moment. As we said, the Australian business is the market's really competitive. And we've had to obviously adapt to that, which we have done, and that's allowed us to continue to grow. Would the growth have been stronger? It's really hard to tell, but we certainly haven't seen any clients taking a lot longer to sign off on projects. I mean, we haven't seen that. We did see a bit more of that in Australia last year, over the middle of the year. We're not seeing much of that at the moment. We're seeing some green shoots in our business in Europe, to be honest. I think the European markets are picking up a little bit, so that's good from that perspective. But there's certainly nothing that, and we obviously, again, are ensuring that we're keeping our eye on everything, talking to clients, trying to understand what's coming up in their business, how they're going, etc., keeping close to them so that we obviously can get those sort of key indicators before, we're in the middle of it all. But certainly there's nothing to indicate that there's a significant drop off in client spend. Maybe it's occurring with some other competitors in the industry, but if we continue to be making sure that we're a market leader in the quality of the work that we do and how fast we do it, making sure that we are, if a client is going to reduce their spending, they're getting the maximum amount of that because we're a strong player in the industry, then that's what Martin and I can focus on, is making sure that every dollar we don't leave anything on the table because, we're not doing a great job for our clients. But nothing that's concerning us at the moment at all. But obviously things could change. But, insights is a really interesting industry. It's, sometimes when you have got recessions or global shocks, it's an opportunity at the same time. COVID certainly was an opportunity for us. there was a lot of uptick in research going on when there's a lot of uncertainty and confusion, and businesses want more certainty, so sometimes they do more research. So it can be a threat and an opportunity, uncertain times, and we're hoping towards more of the opportunity in this sort of uncertain times.
Thanks, Mel. Just to add a couple of things quickly, if I can, George. Firstly, as Mel said, look, we're winning market share from competitors, and that's because of, as Mel said, high quality of data, delivery, and people. That consistency of people, that steady growth that Pureprofile has seen, where people are trusting of the brand to make multi-million-dollar decisions because we're consistent. That's a really important point. The second one is that we have such low market share in the rest of the world that actually it makes you more recession proof or stability if there's lack of trust or faith in the market, whatever, because of what Trump's doing. But we're still winning market share. And to us, if somebody yesterday had $100 in their wallet and today has 80, we didn't know they had 100. So we will win the $80, and we're winning the $80. And what we're seeing is that our big global competitors who are number 1, 2, or 3 in, for example, the UK and the US, they're actually hurting. And they're hurting because there has been, especially in the US, where there is uncertainty, there has been a decline in spend in the US. We haven't seen that anywhere else in the world. And that's great for us because that, as the challenger brand, that is when organizations are looking to say, can I do it cheaper? Can I do it faster with the same quality? And we can, and especially with the new tools.
Great, thanks, Martin. Final question. I'm not quite sure whether you can answer this one, Martin, but it says, another strong set of results. Well done to the whole team. We saw significant new shareholder join during Q3, which is a great sign. Are there any other potential new investors on the horizon?
All right, I've been doing this for now, what is it, 16? This is my 19th update, I think, and I've never said this before in 19 updates. George, would you like to answer this question? Because that's what you do for us. So, George, would you like to talk about your activities for Pureprofile?
Well, I mean, from our perspective, we, every quarter and every half and full year, we try and get the management team to go around and visit investors. That's both existing shareholders and also potential new investors. There's definitely a lot more interest. I think we've now seen 5 years of growth, of consecutive growth, and there's definitely a lot more interest in the market when it comes to trying to schedule meetings and that. So, I mean, I can't speak specifically to the question, but I can say there's more interest now than there was a year ago.
Yeah, and George, how is the fact that whilst we're still a microcap, we're now a profitable microcap? How's that opened up the conversation?
Sorry, Mark, what was that? While you're still a microcap?
Whilst we're still a microcap, we're now a profitable NPAT.
Oh, yeah.
How's that changed the conversations and who we're talking to?
Yeah, absolutely. I mean, a lot of investors, particularly in that microcap space, they're concerned about companies that don't make a profit and don't have cash flow, and that will be looking for the next capital raise to keep them alive. In your case, you're now profitable. You've got positive cash flows. You've had them for quite a while, and investors like to see that, particularly in those small companies. So again, I think it works in your favour.
Thank you very much, George.
All right, no problem. Look, that completes the questions for today. Martin, I might just hand it back to you for any closing remarks you might have.
Look, it's another set of great results, and knowing the team and knowing our clients, it's what we're seeing day in, day out of everybody's work, is that desire to win, is the owner mentality, and it's everything that we have across the business. So I'm really confident that absolutely carries on and that momentum carries on. A huge thank you also to our shareholders who have been with Pureprofile, new ones who have been the last 5 years with us, some new ones who've just joined us, and also ones that have been since the IPO in 2016, because it's with the shareholders' support that we also are able to continually grow and also continue to tell a positive story. So huge thank you to that, and to new shareholders who think you join, come and join. We all want you to come and join the family. But it's the growth that we've seen organically carries on. Managed service carries on, winning that market share carries on. But now we've got a new string to our bow. We're becoming a tech-enabled company. We see that as absolutely a future of all businesses, because that's in effect the AI effect for all businesses. And so I'm really excited now to be able to add that to our discussions moving forward.
Right. Thank you, Martin. Thank you, Martin. Thank you, Mel. That now concludes the investor briefing. I invite you all to now disconnect. Thank you very much.